Hi, hello. Namaskaram. Today let's talk about this book review, How to Listen When Market Speaks. The Risks, Myths and Investments Opportunity. Definitely this is a good book. One thing I definitely learned in this book is buying gold and silver. Everyone says that you should buy. But one of the reason in the book it says is, I'll go into the detail chapter wise, but the one thing he says is the industrial demand for silver is really going up. So if you look at from a supply demand point of view, silver is going to make a new highs because I think 10 years back when it made an all-time high, the industrial usage of silver might not be so high, but now industrial usage of the silver is a high in electronic devices, ships, and all these places. And there are places where they want to use it. And if you see India, um, maybe a couple of thousand years back, majority of the yantras which are made are in gold, silver, and copper. And the chips what we see in artificial intelligence servers are also kind of an yantras only, so they are also using the same thing here for a smooth transition. So today let's talk about let's go into this presentation. So this presentation purely talks about what this book says about, talks about the author's thing. I think they are good guys who has given the prizes for this book: Mark Cuban, Paul Roll, and so many good guys. What I would like to say about the couple of things is very important thing as an investor or as an asset manager. Asset managers, in my own experience, if I have to say, uh, when I balanced my portfolio to multiple assets, I think you should have an Excel sheet where you can clearly demarcate how much percentage goes into real estate, how much goes into the gold, how much goes into the equity, how much goes into the silver. If possible, maybe you can categorize commodities, you can categorize real estate, you can categorize into bonds, you can categorize into stocks. So if something goes wrong also, in sense, if one of the asset class goes wrong also, the other asset class will come and help you. So I think the author is a financial expert, definitely. If he has written a good book, and New York Times, one of his New York best time sellers are a colossal failure of common sense. So that's thing, and that's with James Patterson, I think. Other thing, Patrick Robinson, sorry. So do not rely. I think what he says about why you should listen to the markets is uh, there are, I think, 6 or 7 chapters. The end of era and the American crossing the Rubicon, the dazzling Obama days, like 2008 days. How he came into the picture, how the crisis was there. If I had to say, 2008 financial crisis, the fossil fuel side, the dark side of passive investing, the psychological of bubbles and declines of use. Definitely, I will talk about when market falls, or because most of the people who listen, bulls and bears, the bulls really wants to see when market goes. When it will speak, I'll talk about the both scenarios. I do not remember that. Yeah, let's talk about that. So why you should listen to the markets? When you listen to the markets, it could be the volumes, it could be the price action, it could be the indicators. Definitely markets provides the value and you can make money out of it, and you can identify the opportunities: RSI 10, 20s, 80s, and overboughts, oversolds, and the price actions, monthly highs, monthly lows, and you can manage your risk. Technically, if you have seen something going up for a very long time, the analogy I use is if a car driver is driving for humans, because humans are the ones, it's not the machines driving the universe now at this point of time, still humans are driving. So since humans are driving, humans do have certain energy capacity. If they drive for certain 8 to 9 hours, 10th hour, their energy will reduce. In the same way, if the stock is going up without any correction, it is good that you diversify your portfolio out there and come to other asset class when you see indication where the stock can come down, or underlying asset can come down. So these are the things where you can manage, identify opportunities, and you can make an informed decision. That's why you have to make, everyone is living to make some money. I don't want to say some money, but big money. So definitely they want to make a big money, and that's why you have to listen to the markets. Market doesn't mean only stock markets. You can look in anywhere that a transaction is happening. Just observe, even in a local farmers market. You just go and observe how the markets are reacting. You will learn a lot many things. You can see the customers. You can see the buying and selling, bid and ask, how it's all happening. Signals, market signals do provide a lot much of value if you really want to make money. So if you're a very long-term investor, monthly signals, kind of in a long-term, weekly, kind of in a short-term, daily signals, you can see how they are monitoring the market signals. You can look at the alerts. Market psychology, as you majority, uh, if you have seen this is one of the things I have read in one of the books. Whenever in a main political newspaper, when it comes like when the index is topping, then it is the time everyone is celebrating you should exit. The second thing, when everyone, when you see suicides happening related to stock markets or any other markets for that matter, so because too much of investing happen, real estate, any market, people are getting killing themselves on the name of money, then it is time to go and invest in the markets because it is almost the pain. People have seen the pain, enough pain. So you identify the human psychology, it's extreme fear, extreme greed, and you can see how they are doing. So observe the pattern, analyze the data, and spot opportunities. Obviously, just observing the patterns. If you go to the farmers market, you can see the patterns. If this how the supply is there, how the demand is there, how the farmers increasing the price. And the same with the operators of the stock or underlying asset will move the patterns. They know how the supply demand, and they are very big guys, and they know it. If you go to a farmers market, if there is only one guy who's selling the oranges, he is the big guy in the orange market there, so he knows what is the supply demand. He's a wholesaler. He's selling to the retailers there. So spot opportunities, you can really spot opportunities. And again, you can see that one market is going down. Earlier there is, if stock market falls, gold will go up. Maybe in 2024 it doesn't hold good, but you can see, you can spot the opportunities by looking at the other trends where it's going down and up. Recognize the market patterns, identify the trends, analyze the cycles. Does the cycle falls? I think you have heard cycles, time cycles, Kal Chakra cycles, full moon day, new moon day, Amavasya, Purnami cycles, all those things. You can identify the cycles, and it takes something and recognize the signals, and then you can do something about it in sensing. So if you see at the market, sometimes what I wrote 1.2 trillion, 50 billion, this is like, that's just a number. Why did I say this? Because when markets falls, a lot much of, sometimes $1 trillion wipeout will happen. Sometimes you can clearly see the highest volumes are traded on that day, and you can also see that volatility compared to the past volatility, it has increased a lot. So important thing is, you have to look at the how much market cap it has eroded. Let's think, if it is 30 trillion economy or 30 trillion market cap, I mean entire market cap, the whole Dow Jones and Nasdaq, then suddenly you see 10% or 3 trillion dollar wipeout in a matter of a week or so. Then it is, one, it is signaling something. Second, it might be an opportunity. Also, you have to see the next day volumes and all those things. That's what I was trying to say here. Listening to the bond markets, as you all know, the interest rates and the yield curves, credit spreads, and volatility. See, governments always want to manage the balance between balance in the system. Since they want to manage the balance in the system, all they want to do is, they have something called, the RBI or the Fed. They want to play with the interest. I don't want to use the word play, but they want to manage the interest rate so that the inflation and deflation is handled in such a way there is no much of chaos in the society. So you can see, if the obviously interest rates are happening, then people who want to take the money will be very less. If the interest rates are low, people wants to take money. You should also see how much is the liquidity in the market, all those things, so that way you can analyze the bond market. So definitely, as a portfolio asset manager, it is good that you have some bonds. So if any time you see bonds being the least riskiest, yeah, I can say least riskiest, considering that whenever you see another great opportunity in other markets, you can sell off your bonds and go there. Stock markets, I think indicators, earnings reports, investor sentiments, this all make sense. As I said, like the newspaper analogy earlier, just refer that part. You can go there and see. Listening to the currency markets, you can also see whenever the currency markets. I think the currency markets makes a lot much sense. Maybe they, sometimes you don't know, the stock markets can react, or the currency markets can react. So it is good that if you have a diversified portfolio, you can look at your portfolio at the exchange currency also, because you can hedge your you can hedge. I see people who do import export business, they do hedging a lot. It is good that they do. I think all the governments should also do the hedging, because small, I mean, when we have 200 countries across the globe, it is good because whenever you have too much dependency on oil or any commodity for that matter, it is good that you do serious hedging, and you can still make, see, Infosys makes a hedging on against the dollar, and because they get the money from their clients, and they just sell the dollar on the other side, because the inflow is there outside. In the same way, the governments can also um, do the hedging part. So timing the transaction, it is very very important. Just like, because you've seen some data, you don't jump in, you should also time. Nobody knows the correct time, but you can still. And the commodity markets, as I said, you have to diversify enough where you, as an asset manager, should be very happy if stocks are falling, your gold or silver or oil is going up. So that way you are covered up your losses in a portfolio. You are not like you can't show a face to your investors or your customers. But if you have a balanced portfolio, I've seen like Microsoft's Bill Gates portfolio, it just earns 9 to 12%, but that's a fantastic return on such a big portfolio. Governments also should consider that. See, his fund manager or asset manager, majority of his investments are into bonds and very low risk assets. So I really like it. In a matter of some time, in matter of I don't want to say years, even the portfolio can continue for decades and decades and centuries also, if that kind of portfolio management. So in that portfolio, I'm saying, what I'm saying is the commodities should also come into the picture, because if you really want, do not rely on single markets. I'm not saying purely on gold or silver or on stock markets. It has to be all together. If it is all together, then it's going to change, or it is ready to absorb the shocks, any kind of shocks you get. I would say like the 25% stocks, 25% commodities, 25% real estate, 25% bonds. This is a classic thing. I don't know, the author said this, but it's my personal thing. So integrating market insights, when you have multiple inputs from the multiple assets, then you can definitely integrate all those things. Once you have those stuff, you can monitor and you can analyze the market data, and you can develop the strategies, and you can monitor that, identify the shifts. Why, technically, you can see it. If one market is falling, other market is going up, so wherever it's going up, you can invest, or it's falling, you can see shorting opportunity. Adjust your strategies and manage your risk. And this, thanks for listening. And I would definitely say, one important thing I learned in this book is industrial usage of gold and silver is going up. Industrial usage of silver is very high. If you see here, the batteries part, earlier, I'm not talking about the lithium batteries. Nobody even give a shit about lithium 10 years back or 20 years back, when no electric cars are there, but everyone are going back the lithium now. The shares are increasing. The same thing applies to nuclear energy also. So find out where are the trends, and the trend is going to continue for other 20-30 years. If that's going to continue for 20-30 years, nothing wrong investing in the in the respective asset class. Another example he says about, the other talks about shaking hands with Charlie Munger during the annual meet of Berkshire Hathaway. There was a small guy. I know Charlie. We all know Charlie. So Charlie Munger. So he was shaking hands with everyone whoever coming into the home, into his town hall. So that actually shows how much humble you have to be there, even if you are a big billionaire. I would end here, and if you really want more, you can connect with me. You can see my links in the comments, and we can have a consulting, and we can see how you can make your portfolio better returns. Thank you, and have a great time ahead.